Your paycheck hits your account on Wednesday like it always does. Rent is scheduled to pull on Friday. Groceries, utilities, your car payment, all lined up exactly the way you planned. But this time, something's different. The deposit shows up and then it doesn't. Instead, you see a notice. Funds on hold, pending review. No warning, no explanation, just your own money temporarily frozen because the system flagged it as unusual. And here's the part almost nobody is talking about. This can now happen even if you did absolutely nothing wrong. In 2026, a new banking rule quietly approved behind the scenes is changing how banks monitor your account. Not just the money going out, but the money coming in, your paycheck, your tax refund, a transfer from a family member. All of it is now subject to deeper automated scrutiny. And while this change is designed to protect you from increasingly sophisticated fraud, it also means legitimate transactions can get caught in the crossfire. One unexpected bonus, one new payment source, one irregular deposit pattern. That's sometimes all it takes for your account to be flagged for review. If you rely on direct deposit, autopay, or government benefits, this affects you. If you assume your paycheck will always clear instantly, this affects you. And if you think fraud only happens to other people, what's coming next might surprise you even more because the speed of money itself is changing. Payments now move in seconds 24/7, which means fraud can happen in seconds too. And when money moves that fast, banks respond by tightening the filters. The real question isn't whether the system is getting safer. It's whether you know how it works before it affects your account. Because here's what banks aren't explaining clearly. The same technology protecting you can also temporarily block you. And if your rent is due or your mortgage autodrafts overnight, even a short delay can create a domino effect. Overdraft fees, declined payments, credit impacts. Most people won't see this coming, but by the end of this video, you will understand exactly what changed, why it changed, and how to make sure your own money doesn't get stuck in limbo. Today, I'm going to walk you through what was officially approved, what starts rolling out this year, and what it means for your direct deposits, automatic payments, fraud protections, government benefits, overdraft fees, and even how fast money moves between banks. Some of these changes are genuinely good for consumers. Others require you to pay closer attention than you might be used to. Either way, the goal isn't fear, it's preparation. Let's start by zooming out for a moment because this isn't just one isolated tweak. It's part of a much bigger modernization of the American banking system. And once you understand why this rule exists, you'll see exactly why your account activity is about to be watched more closely than ever before. To understand why this new rule was approved, you have to understand what's been happening behind the scenes in the banking world over the past few years. The way money moves in America has fundamentally changed. We've shifted from a system that processed payments in batches during business hours to one that increasingly operates in real time 24 hours a day, 7 days a week. That speed is convenient. It's powerful, but it also creates risk. Fraud today doesn't look like it did 10 years ago. It's no longer just someone stealing a debit card and going on a shopping spree. Criminal networks now exploit digital payment systems, social engineering tactics, stolen personal data, and even artificial intelligence to move money rapidly through multiple accounts before anyone notices. In many cases, they don't just steal from accounts. They manipulate deposit flows, create temporary credits, or trick people into authorizing payments themselves. And once funds move instantly, recovering them becomes dramatically harder. This is where NACHA comes in. NACHA is the organization that governs the AC network, the system responsible for direct deposits, payroll, government benefits, mortgage drafts, subscription charges, utility payments, and most of the automatic transfers touching your bank account every month. If you get paid through direct deposit, you're using the AC network. If your car payment drafts automatically, that's one of the most important financial systems in the country. Historically, banks focused most of their fraud detection on outgoing transactions, money leaving your account. If a strange debit showed up, that was the red flag. But criminals adapted. Instead of just pulling money out, they began manipulating incoming funds, pushing fraudulent deposits into accounts, using compromised identities to route money through innocent people's accounts, or exploiting timing gaps before reversals processed. So, regulators and payment networks concluded something simple but significant. Watching only one side of the transaction wasn't enough anymore. That realization led to the 2026 rule change. Banks are now required to monitor both debits and credits more aggressively. Not just the money leaving your account, but the money entering it. Every direct deposit, every transfer, every incoming payment is now subject to expanded risk analysis. The system looks at patterns, frequency, source, timing, historical behavior, amounts, and assigns a risk profile in milliseconds. And here's where this starts affecting you directly. Let's say you normally get paid every other Friday from the same employer for roughly the same amount. The system recognizes that pattern. It expects that pattern. Now imagine your employer issues a surprise midweek bonus. Or maybe you worked overtime and the deposit is significantly larger than usual. To you, that's great news. To an automated fraud detection model, it's an anomaly. Anomalies trigger review. That doesn't automatically mean something bad happens. Often, it clears instantly. But sometimes, especially if multiple unusual factors stack together, new amount, new day, maybe even a slightly different deposit descriptor, the system may temporarily hold the funds for verification. Not because you did something wrong, not because your employer did something wrong, but because the system is designed to slow down anything that doesn't fit the historical pattern. Now, imagine that happens the same week your rent autodrafts. If your landlord's payment pulls before the held deposit clears, your account balance might not reflect the incoming funds yet. That can mean a declined transaction or even an overdraft situation depending on your settings. And this is where people get frustrated because from your perspective, the money is yours. It was sent legitimately. But the bank's job under these new requirements is to verify before fully releasing. This doesn't just apply to payroll. Think about tax refunds. Many Americans receive a refund once a year, often a larger deposit than anything else that hits their account. Fraud rings frequently target tax season because stolen identities are used to file fake returns and redirect refunds. So, when a large one-time federal deposit appears, especially if it differs from prior years, it may be subject to enhanced screening. Or maybe a family member sends you money unexpectedly, or you sell something online and receive a transfer from a buyer. New source, new pattern, new behavior. All of those variables feed into automated risk scoring systems that now operate more comprehensively than they did before. Now, here's the important part. This rule was not created to make your life harder. It was created because fraud losses across the financial system have exploded. Banks are under pressure to reduce unauthorized transactions, prevent account takeovers, and protect both consumers and institutions from cascading losses. Monitoring both sides of the ledger significantly increases their ability to detect sophisticated schemes early, and in many cases, this absolutely benefits you. For example, if someone attempts to route fraudulent funds through your account as part of a larger laundering scheme, enhanced monitoring could block it before you're unknowingly entangled in something serious. If a criminal tries to deposit a manipulated check that later bounces, deeper screening might stop that credit from ever appearing available in the first place, preventing you from spending money that would later be reversed. So, yes, the system is becoming stricter, but it's also becoming smarter. If this breakdown is helping you understand what's really changing and why, make sure you're subscribed so you don't miss the next updates rolling out this year. Because this is just one piece of a much larger transformation happening across the banking system. Now here's where things get even more interesting. Under the old structure, many fraud investigations were reactive. Something posted, then it was disputed, then it was investigated. The 2026 framework shifts much of that to a proactive model. Instead of waiting for damage, the system tries to predict it. That predictive approach relies heavily on behavioral consistency, which means your historical account behavior matters more than ever. If you regularly transfer money between accounts, the system adapts to that rhythm. If you suddenly begin sending large amounts to unfamiliar recipients, that deviation increases scrutiny. If your deposit patterns change frequently, gig income, side hustles, inconsistent payment sources, your account may naturally generate more alerts simply because it doesn't follow a traditional payroll model. This doesn't mean gig workers are targeted. It means variability is inherently harder for algorithms to categorize as safe. The more predictable your account history, the easier it is for automated systems to distinguish normal from abnormal. And in 2026, those distinctions are happening continuously in the background. So, what should you take away from this? First, don't panic if you ever see a temporary hold. It doesn't automatically mean something is wrong. It often means the system is doing exactly what it was programmed to do under the new rules. Second, if you anticipate an unusual deposit, a bonus, a large refund, a one-time payment, it may be wise to keep a small cushion in your account in case there's a short verification delay. That buffer can prevent overdraft domino effects if outgoing payments process before incoming funds are fully cleared. And third, get in the habit of monitoring your account activity more actively than you might have in the past. Not obsessively, but regularly. Because the new environment rewards awareness, the banking system is becoming faster, more automated, and more protective at the same time. And that balance, speed versus security, is exactly what we're going to explore next. Because once instant payments enter the equation, the stakes change even more dramatically. Now, while expanded monitoring might sound like it only creates friction, there's another 2026 change that quietly works in your favor almost immediately. And it has to do with something that has frustrated people for years: confusing transaction labels. You know exactly what I'm talking about. You open your banking app and see a charge that looks like XYZP84729CA, and you have absolutely no idea what that means. Is it a subscription, a purchase, fraud, a free trial you forgot about? You're forced to either Google it, dig through old emails, or wait until it posts fully to get clarity. That confusion doesn't just annoy you, it delays fraud detection. Under the updated standards, companies processing a payments are now required to use clearer, standardized transaction descriptions. Payroll deposits must clearly reflect that they are payroll. Consumer purchases must be labeled in a way that indicates their purchases. The goal is simple. When you glance at your statement, you should immediately understand what category of transaction you're looking at. This might feel like a minor cosmetic upgrade. It's not. Clearer descriptors dramatically improve two things: your ability to self-monitor and your bank's ability to detect suspicious activity quickly. If your deposit says payroll and it matches your employer, that's instantly recognizable. If a debit says purchase from a merchant name you've never seen before, that stands out immediately. The less time you spend decoding vague strings of letters, the faster you can act if something doesn't look right. And here's the part most people haven't thought about. Clearer labeling also reduces false positives over time. When transaction categories are standardized, fraud detection systems can classify behavior more accurately. That means fewer gray areas, fewer ambiguous flags, and ideally, fewer unnecessary holds once patterns are established. But even with clearer labels and smarter monitoring, fraud still happens. And this next change may be one of the most consumer-friendly upgrades we've seen in years. In the old system, if you noticed a suspicious charge while it was still pending, there often wasn't much your bank could do. You'd call and explain that you didn't authorize it, and the representative would tell you they had to wait until it officially posted before filing a dispute. So you'd sit there watching that pending charge hover for 2 or 3 days, knowing the money was about to leave your account, unable to stop it. Once it posted, you could file a claim. Then, the investigation would begin. Temporary credits might be issued. Paperwork might be required. Meanwhile, your available balance was reduced. If your budget was tight, that delay could cascade into overdrafts, missed payments, and stress that far exceeded the original transaction amount. The 2026 rule framework changes that dynamic significantly. Banks are now permitted to initiate what's called a written statement of unauthorized debit, a WSUD, as soon as an unauthorized AC transaction is identified, even while it's still pending in certain circumstances. In simpler terms, that means the process to stop or reverse an unauthorized debit can begin earlier, potentially before the money fully leaves your account. That's a meaningful shift from reactive to preventive. Imagine you notice a $300 debit you don't recognize late at night. Under the old system, you might have had to wait until it posted the next day. Under the new framework, depending on timing and bank policy, you may be able to report it immediately and trigger intervention before completion. That reduces the window where your funds are unavailable and limits downstream financial disruption. For people living paycheck to paycheck, this matters. A temporary loss of even a few hundred can trigger overdraft fees, returned payment penalties, and late fees on other obligations. Stopping the transaction earlier doesn't just protect the single charge, it protects the stability of your entire account flow. There's also another important dimension here: documentation and communication between banks. The updated standards strengthen how financial institutions coordinate when unauthorized debits are reported. That improves recovery timelines and accountability across the network. Now, I want to be clear about something. This doesn't mean every fraudulent charge will be magically blocked before it posts. Payment systems are complex and timing still matters, but the rule change expands the tools banks have at their disposal, and that increases your chances of limiting damage if you act quickly. Speed now works both ways. The faster you identify something suspicious, the more leverage you have under the updated framework. That makes regular account monitoring more valuable than ever. Not obsessive checking, just consistent awareness. A quick glance every few days can make a significant difference in how a fraud case unfolds. And there's one category of fraud where this evolution becomes even more important, because in those cases the victim technically authorized the payment. I'm talking about social engineering scams. These are the situations where someone doesn't hack your account. They manipulate you. They create urgency. They impersonate authority. They convince you to move your own money. And historically, those cases have been the hardest for consumers to recover from. That's exactly where we're heading next, because 2026 introduced a critical shift in how those scenarios are handled. Now let's talk about the type of fraud that doesn't rely on breaking into your account. It relies on breaking your focus. Social engineering scams have exploded over the last few years. These are the calls, emails, and text messages designed to create panic, urgency, or emotional pressure so intense that you act before you think. Someone claims to be from the IRS, saying you owe back taxes and must pay immediately or face arrest. A caller pretends to be your grandchild in jail needing bail money right now. A pop-up appears on your computer warning that your bank account has been compromised and instructing you to secure your funds by transferring them elsewhere. In these cases, no one hacks your password. No one steals your debit card. You authorize the payment yourself because you were deceived. Under older banking rules, this created a painful gray area. Since you technically approved the transaction, banks often categorized it as authorized. That made recovery far more complicated. Even if you were clearly manipulated, the system treated it differently than an outright unauthorized debit. The 2026 updates shift that conversation. The new framework introduces clearer recognition of payments made under false pretenses, essentially acknowledging that authorization obtained through deception isn't the same as legitimate consent. Banks are now required to take these cases more seriously, improve communication across institutions, and attempt recovery efforts more proactively when social engineering is involved. This doesn't guarantee refunds in every scenario. Fraud recovery still depends on timing and whether the funds can be located. But the regulatory posture has changed. Instead of defaulting to you authorized it, banks must now evaluate the surrounding circumstances more carefully. That means better documentation standards, more coordinated response procedures, and greater institutional accountability. Why does this matter so much right now? Because the speed of money has changed. Instant payment systems like the Federal Reserve's FedNow service allow funds to move between banks within seconds, any time of day, any day of the year. Weekends, holidays, 2 a.m. on a Sunday, it doesn't matter. The system doesn't sleep anymore. That convenience is powerful. If you need to send emergency money to a family member, it can arrive instantly. If a business needs funds after hours, it doesn't have to wait until Monday morning. Payroll, vendor payments, peer-to-peer transfers, all of it can move in real time. But speed removes the cushion that once existed. In the old AC system, transactions often processed in batches. That delay sometimes created a window where suspicious activity could be identified before completion. With instant rails, once money is sent and accepted, recovery becomes significantly harder. Funds can move across multiple accounts in minutes. That's exactly why enhanced monitoring and stronger social engineering protections were implemented at the same time. Faster systems require smarter safeguards. Here's a realistic scenario. You receive a call from someone claiming to be from your bank's fraud department. They tell you your account is under attack and that you must immediately transfer your money to a secure account to protect it. They provide convincing details. maybe even your address or partial social security number obtained from a data breach. You panic, you act, you send the funds instantly. Under the instant payment framework, that money could be gone within seconds. But under the updated rules, banks now have clearer responsibilities. When you report that the authorization was obtained through deception, the receiving institution must cooperate more actively. Documentation standards are stronger, and the definition of unauthorized has evolved to reflect modern scam tactics. This is a recognition that fraud today isn't always about technical hacking. It's about psychological manipulation. If you know someone, especially a parent or grandparent, who relies heavily on phone-based banking or who might be vulnerable to high-pressure scams, consider sharing this information with them. Awareness is often the only barrier between a manipulative caller and a drained account. Now, while we're talking about vulnerability, there's another major shift happening in 2026 that affects millions of Americans, particularly retirees and people receiving federal benefits. Paper checks are disappearing. The U.S. Treasury has been aggressively phasing out physical checks for government payments like Social Security benefits, veterans benefits, and tax refunds. Mail theft has surged across the country. Criminals have been stealing checks directly from mailboxes, chemically washing them to remove original details, and rewriting them for thousands of dollars. It's a growing problem. So, by 2026, the federal government is pushing almost entirely toward electronic disbursement. That means direct deposit into a bank account or funds loaded onto a government-issued prepaid debit card. From a security standpoint, this makes sense. Electronic deposits are harder to intercept physically, but it also forces millions of people, especially older Americans who may prefer paper systems, into fully digital banking environments. And that's where the expanded monitoring rules we discussed earlier become even more relevant. If your Social Security payment is now deposited electronically each month, you can't simply wait for a check to arrive and deposit it manually. You need to verify that the funds posted correctly. You need to monitor for unauthorized withdrawals. You need to understand how your bank handles holds, reversals, and suspicious activity alerts. The set it and forget it approach doesn't work as safely in a fully digital ecosystem. If you or someone you care about receives federal benefits, make sure direct deposit information is up to date and accurate. Confirm routing and account numbers carefully. And once electronic deposits begin, build a simple routine, even just checking the balance and transaction list shortly after the expected payment date. Because in a system that moves faster and monitors more aggressively, awareness becomes your strongest protection. And we're not done yet. There's another layer to this modernization wave that affects how quickly money can move and how quickly overdraft situations can escalate, especially when interest rates and bank policies start shifting at the same time. That's where we're heading next. Now, that instant payments are becoming more common, there's a side effect most people don't immediately think about, and that's how quickly overdraft situations can snowball. In the older banking model, transactions often processed in predictable windows. If you made a purchase late Friday night, it might not officially post until Monday. That delay sometimes worked in your favor. A deposit arriving over the weekend could settle before certain debits finalized, preventing a negative balance. But as payment systems speed up with instant transfers and faster processing, the timeline compresses, money leaves faster. Sometimes money arrives faster, but the sequencing becomes tighter. That means if your available balance is miscalculated, even briefly, fees or declined payments can trigger more quickly than before. Let's break this down in real-life terms. Imagine your account balance shows $500. You're expecting a $200 direct deposit later that day. You schedule your rent payment for the morning, assuming the deposit will clear before the rent pulls, but the deposit gets flagged for review for a few hours under the new monitoring framework. Meanwhile, your rent debit processes immediately. Now, your available balance drops negative. Depending on your overdraft settings, one of two things happens. Option 1, the bank declines the rent payment. That might avoid a fee, but it could create late charges from your landlord or impact your rental history. Option 2, the bank covers the transaction and charges you an overdraft fee, often around $30 to $35 per occurrence. Overdraft fees have been one of the most controversial topics in consumer banking over the past several years. Large banks historically generated billions annually from these charges. Critics argue they disproportionately impact customers living paycheck to paycheck because one shortfall can cascade into multiple fees within days. There was an effort at the federal level to cap overdraft fees at $5 for large banks. That proposal was projected to save consumers billions per year. However, Congress overturned the rule before it took effect. So, nationally, most major banks still set their own overdraft fee policies. That said, some states have begun implementing their own versions. California, for example, approved a cap of $14 for certain state-chartered credit unions. But this doesn't apply to large national banks operating there. So whether you see relief depends heavily on where you live and what institution you use. Here's why this matters in 2026 specifically. When fraud monitoring tightens and payment speeds increase at the same time, temporary mismatches between deposits and debits become more likely. Even short holds on legitimate deposits can create narrow timing gaps. If you're operating with very little buffer in your account, those gaps matter. One practical strategy is reviewing your overdraft protection settings directly with your bank. Many consumers don't realize they can opt out of overdraft coverage for certain types of transactions. If you opt out, your debit card purchases and ATM withdrawals will typically be declined instead of approved with a fee. That can prevent a $5 coffee from triggering a $35 penalty. For recurring payments like rent or utilities, overdraft policies may work differently, so it's important to ask your bank exactly how they handle a debits versus card transactions. Every institution structures this slightly differently. Another important factor is balance alerts. Most banking apps allow you to set low balance notifications. In a faster payment environment, real-time alerts become extremely valuable. A simple text message when your balance dips below a threshold can give you just enough warning to transfer funds, delay a purchase, or contact your bank before a situation escalates. Now let's shift gears slightly, because while some of these changes tighten monitoring and accelerate transaction speeds, another 2026 development actually increases your flexibility as a customer. It's called open banking. For years, switching banks has been a hassle. Think about what's involved. You have to update direct deposit with your employer, change autopay details for utilities, subscriptions, mortgage, insurance, transfer savings, close the old account. It's complicated enough that many people simply stay with a bank they're not fully satisfied with. The new open banking rule finalized by the Consumer Financial Protection Bureau changes that dynamic. Under this framework, banks must allow you to securely access and transfer your financial data to other institutions or approved third-party apps. In simple terms, your financial data belongs to you, not your bank. If you want to switch from Bank A to Bank B, the process should become significantly easier over time. Large banks must begin complying starting in April 2026, with smaller institutions phased in over several years. Why is this significant? First, it increases competition. They'll be the ones who pay attention early. If this breakdown helped you understand what's happening behind the scenes with your bank account, make sure you're subscribed so you don't miss upcoming updates. Financial rules evolve quietly, and the earlier you understand them, the more control you keep over your own money. Because at the end of the day, this isn't about regulations or institutions. It's about your paycheck, your savings, your bills, your financial stability. And in a system that's moving faster than ever, staying informed isn't optional anymore. It's protection,